Hey guys, so welcome back to the channel. So today I had a request to go through how I use liquidity in my trading. So I'm going to be taking you through what liquidity actually is and how we can use it as an extra confluence when going in particularly aggressively on a trade. So sometimes I won't wait for the confirmation entries. If you don't know what the confirmation entries are, I have a video on that previously on my channel, so you can check that out if you want. However, sometimes price you can anticipate will not give you a confirmation, and this is when we sort of go in aggressive on the trade, and I normally use liquidity as the extra confluence for when to go in aggressive. So if we get into the charts now, I'll take you through a few examples of when I would actually use this. Alright guys, so first of all, I want to take you through the 4 types of liquidity that I will actually identify and use. So the first one would just be equal highs and lows. So what liquidity basically is when orders build up in the market. So sometimes you will see price gravitate towards these areas to take basically that liquidity, and then it uses it as fuel to move in the opposite direction. So everything you see in the market, so if we go down here a little bit, everything you see, all of the support and resistance, supply and demand areas, they work because they are areas of liquidity. And once price comes to areas of liquidity, it reacts from them. So notice here how we had these build up of wicks where people would probably have been selling and maybe holding their positions all the way down to the lows. Price comes up and retests, and once it has come above all of these wicks, it then just stops and makes its move back down because it has taken liquidity, and that's basically the purpose of the move that it just made. So 4 types of liquidity. Number 1 is when we have equal highs and lows. So if I get the tool up. So equal highs is quite an obvious one. Every trader probably knows it. It's a double top, or if you're looking at equal lows, it's a double bottom. And how we're trading this is from the perspective of liquidity. So we're not looking to enter trades when you get the second tap of that first head for the double top. What we're looking at is this being liquidity. So what I mean by that is that price has created these equal highs here, and there is basically money resting above those equal highs because this is where the majority of retail traders will be selling. So you got to think that these retail traders are the 95% of people that are losing money, and so what they are doing is generating money, and then they are most likely going to lose. And so we basically want to enter when they lose, which is when price comes above the double top, taps into our key level to the left, and then you often see price drop just like this. So I'll go through an example of this. There was a very nice example on GU this morning. I don't know why it's deleted all the drawings, but so we had this level of supply marked out to the left, this one here. You can see it was a clear imbalanced area of supply, which caused this push down and broke this structure. And what we can identify is that we have multiple areas of liquidity resting below. So notice how when price came quite close to it, but it hadn't actually touched, we created these equal highs. So we can mark that on as liquidity, because what we can see is that most people are selling in this area here. So what is price likely to do is likely to come above, take out all of those losing traders, and then we enter when they lose. So we also have this area to the left which we want to enter from. We don't want to just enter when price randomly comes above a double top. We want to identify levels in line with the trend to the left, which are key levels. So in this case it was the supply, and we would have entered here with a stop loss just above, and then targeted probably this low. You basically want to have your targets as well where the next point of liquidity is. So this is a point of liquidity. There's a build-up of orders in this area, so price is likely to react from this level. So yeah, that is the first example of liquidity that I personally use in my trading. So the second type is quite similar, and a lot of retail traders do use this as a confluence when they enter trades. It is simply trendline liquidity. So from our perspective, we can see that price is building a trend line. We have a nice trend line like this. And what we are seeing that as is liquidity. So we are waiting for price to come below the trend line, fake it out, and then continue its move to the upside. So in this case, you have two types of traders that will be losing in the position. So one type of losing trader would have extended the trend line and will be entering on the next touch like this to continue the move up. The next type of losing trader will wait for the trend line to break like this, and they'll be waiting for a retest of this trend line to then go short. But what we are going to do instead, we identify an area of demand down here. And so once price has broken the trend line, price comes into our level of demand, takes out the liquidity, and continue its move to the upside. When we are trading like this though, we want to make sure that our level of demand is still in line with the trend. So if this low here had broken as well, like this, I would consider that a trend reversal and we would no longer be looking for buys. So we want to bear that in mind. But anyway, if we go to a nice example that I had on USD CAD, back on end of 21. Okay, so this was a trade that I did decide to go in aggressively on, just based on, like I said, the extra confluence of liquidity. But obviously that wasn't the only confluence that we had in this trade. So for this trade, at this point in time, we were looking for buys, reason being, we had this area of supply here, which was the most recent area of supply in the downtrend and the level that you would expect to hold if price was to continue down. We had this initial reaction from it, but ultimately price came above and failed to hold that supply. So at this point in time, I was expecting further buys. And what I noticed was that if we go a bit lower, we have a very nice area of trendline liquidity building up just here. And what we can see below, we also have an imbalanced area of demand just immediately below this area of liquidity. So simply what we do in this case, we have all of our confluence lined up. We had the change of character when the area of supply fell. We have price clearly printing bullish price action. We have liquidity. We have a discounted area of imbalanced demand. We simply set the limit and go in aggressively for this trade. If you are a bit more of a conservative trader, you could use this as just a point of interest and wait for a confirmation in that zone. But like I said, sometimes in these cases where price grabs liquidity, comes into your area, it will often have a very impulsive reaction if the trade is going to win. So a lot of the times you will not get a confirmation. Like in this case, if we play price, it taps in and then it just immediately spikes to the upside, and there wasn't really a confirmation unless you would have entered once when you were seeing price make this very impulsive move down, which because of psychology you probably wouldn't have. You know, most people would see this big drop down and they think, oh no, it's going to be a stop loss, and they wouldn't think to re-enter at this point down here. So you wouldn't have had a valid confirmation for that trade, and you would have wanted to go in aggressively from this point based on the previous confluences that I just discussed. So next type of liquidity that we can identify is actually the Asian session range. So if you are in the UK, so GMT time, the Asian session is between around 11 PM and 7 AM. And a lot of the times on USD pairs particularly, you will see that price simply consolidates in this session like this and doesn't really do anything. It kind of stays within this one range. If I show you an example of this, same example as earlier on GU. So you can see that, actually I have a better example, Euro Swiss. Believe it was here. Right, so I'll go through the full trade in a bit, but first of all, we will just identify where the Asian range is. So notice the timing. This is the Asian open. This is around about the Asia close at 7 AM. So this whole area here is basically the consolidation that happens during Asia session. And what we normally see is that price will either manipulate the lows or the highs of the Asia range and then go in the opposite direction. And by manipulate, I simply mean when we have the lows, they will be taken out, and then price will move impulsively in the other direction. Because we can think, most people, when they're seeing this, imagine price does this, we break below this level here. A lot of people will be seeing that as a break of structure, and a common retail strategy is to simply enter on the retest of that support level that broke to then sell back down. However, we also know that those people are likely to lose because they're part of the 95% of losing traders. So we want to basically be entering in the opposite direction to them when they lose. On top of that, for this trade, I won't go too much into detail about the reasoning behind this area, but we did have this point of interest here marked out. And then when price came into that level, we very clearly had a change in structure from bearish to bullish. Price failed to hold this level of supply. We broke this structure very impulsively, and we left this huge imbalance for price to come and fill. On top of that, we had this very clear area of imbalanced demand, and our extra confidence for going in aggressive. We have the Asia range resting directly above it. And so at this point, we just, again, set the limit and forget about it. And we would probably have been targeting the next imbalanced supply, which was this level up here for 1 to 6. And if we watch what happens now, price comes down, takes out the Asia low, and then very impulsively moves up. Like I said, happens most of the time when you get these areas of liquidity generated above your point of interest, and then eventually price does come up and hit our take profit. So that was the third type of liquidity. The last type now is something that I don't really see too many people using, but I have found that it works particularly well on GU and gold. And this fourth type of liquidity is basically previous day lows and highs. So if on Tuesday price comes to a specific point and then retraces, price then the next day, so the Wednesday, will come below that low, move back up, break structure, and then we can enter on an area of supply or demand. That sounded a bit confusing, but I will go through an example in a moment. But if we draw it out first of all, so the scenario that we're looking at, price is overall in a 4-hour or higher time frame uptrend. What we are looking for is for price to make a retracement, maybe to this sort of level, give us a little bit of a bounce. So most retail traders, they're buying at this sort of high level, and they may go in a little bit of profit because prices bounce from that level. But imagine this is the Thursday, like it says at the bottom. Price has stopped immediately above an imbalanced area of demand. We are going to wait for price to take that low, come into the area of demand, and then a certain percentage of the time, price will then come up, break structure, and then we wait for a retest to continue buying. I'll go through a clear example of this in a minute. Okay, so there was a very good example of that just here. So overall, we can see that price has been downtrending, and so at this point we'd only be looking for buys. From a liquidity perspective, you see that price came above this lower high. So a lot of people would probably be thinking that at this point is buys, but because price actually failed to hold above that level for a sufficient period of time, it pretty much came immediately back below this zone. This probably can be considered a fake out. From our perspective, this was a liquidity grab. Price comes up and then it's going to continue its move down and probably take out this low. But looking more of an intraday perspective, so price took out this low here, which we could consider a break of structure. So if we mark that on, price has clearly broken this area of structure, failed to maintain the bullish momentum, and we could see price at least come down to this area of imbalanced demand. If we are to see buys, which could still potentially happen since we have had technically this break of higher time frame structure, but we are not at that level at the moment. So focusing on this downtrending piece of price action here, we could potentially see sells down to that level. So going back to the point, the previous day high that we are looking for price to come and take is this one here. So notice how this was Tuesday, this was the New York Open, and it was just this very big wick. And to the left, we also created these equal highs here. And what can we see above that to the left? We have this very nice level of imbalanced supply immediately above the liquidity. So this was the previous day high. We now come into the Wednesday. So a very high probable level to enter from would be this level, since we have multiple confidences for it. We have overall downtrend, price has taken liquidity, broke structure, and at the extremum of the current leg, so the highest point above an area of liquidity, price has left this inefficient level of supply. So for this trade, I would have gone in aggressive with stops just a little bit above, and our target would be this imbalanced demand down here. And if we watch what happens, as soon as price taps into the level, it doesn't give you any chance to have a confirmation entry. It simply spikes down and pretty much immediately comes to the take profit. And again, that is why when you have setups like this with sufficient liquidity below your areas or above your areas of interest, you don't really want to wait for a confirmation all the time. And sometimes you will want to go in aggressively. Obviously, if you are going in aggressively, you will probably have a lower win rate. But I found that most of the time, if you go in aggressive, the risk to reward is higher. So that kind of compensates for that anyway. But if you guys did find this video useful, make sure to like, subscribe, and I will see you in the next one.